China's falling GDP costing Australian jobs. Let's have a look. Hello everyone, Florian Heise here, still working through my stein of coffee. Probably get about 2 videos out per stein, so I'm not drinking that much, everyone. I thought we'd have a look at this article from ABC about China's economy hitting a 3-decade low. Now before we jump through this, let's have a look at a bit of other information just to get an understanding of just the impact this might have on Australia and Australian jobs. And just keep in mind, remember, our federal treasurer, wasn't concerned about the China-US trade war having an impact on the Australian economy and the federal budget, because he hoped domestic demand in China would be there for Australia's resources. Okay, just remember that. That's his hope or economic plan. Now, before I look at this, I'm going to have a shot of coffee. That's good. I like it. So, Chinese economy advanced at 6% year on year. Now that may sound good. A 6% GDP growth is great, but you've got to understand the figures are all a bit rubbery with what we get out of China, and it's to do with the delta change from one period to another. We can see here it's gone down from 6.2 to 6% growth. And let's jump out to 5-year on the data, and you can see, well, that's a big drop. Look at 2016 here, 2014, 15. Look at this area, it's heading down. Let's just have a look at how much money is, well, how much investment was coming into Australia. Foreign investment into our housing, that's the black line there as a percentage of building approvals, over 90%. About a third of that was from China. So there's a slowdown there. Is that a correlation as to why it's declining as well? Perhaps. Let's have a look. Let's jump out to max, because, I mean, look at this. This is insane. Look at that, over 14%. I mean, yeah. Okay. Yeah, that's crazy. That's crazy. Now, let's look at the Observatory of Economic Complexity to get a bit of an understanding of the Chinese economy, at least from an export-import perspective. Now, their economic complexity is quite high compared to us, 33rd in the world. Their exports 2.41 trillion, imports 1.54. GDP per capita is not that good. Look at what they're exporting though. Lots of manufactured stuff. Machinery, 1.17 trillion. What do we have next? Textiles, 239 billion. What's this one here? Miscellaneous, 175 billion. So, you know, a lot of manufactured goods. What are they importing? Still, a lot of machinery. Integrated circuits, they're importing a lot of those. I imagine from the rest of Asia. A lot of other things. Here's their trade balance. The destination for a lot of their exports, number 1 is United States, then Hong Kong, Japan, Germany, South Korea, and origins. Australia isn't in the top 5. Where's Australia? There we go. We're 5.5%. Origins of Chinese imports. Now, let's have a look at good old Australia. Our economic complexity, 59th in the world. So our economy is not, frankly, not that complex, guys. It's pretty primitive. Our exports, 20th in the world, 243 billion. Imports, 199. GDP is looking nice, 48k. It's all in US dollars. Look at what we're exporting, guys. Iron, coal, petroleum gas, bit of gold. Look at what we're importing. A whole lot of manufactured goods. And let's just look at where we're exporting. China. Okay, so a slowdown in the Chinese GDP, we'll jump back to this article, a slowdown in the Chinese GDP is understandably concerning for the Australian economy because so much of our exports are heading to China. A lot of it is raw materials. Mining, as an example, is a significant portion of Australia's workforce. So let's have a look at this article. China's economy hits a 3-decade low with GDP growth falling to 6%. I mean, falling to 6%. Yeah. Anyway. So, key points. At 6%, China's GDP is right at the bottom of the government's 6 to 6.5% target for the economy. Trade data points to weaker demand for Chinese exports, while domestic demand for imports is also shrinking. And this is what we need to be worried about. The domestic demand in China for imports shrinking. That is going to flow through to us, guys. It's going to flow through to us. And where have we spent? Where has our civilization invested all of the money from the mining boom? Well, let's say cracking apartment buildings perhaps is a big chunk of it. Monthly data pointed to factory production picking up in September and slightly stronger retail sales. Okay. It is the fifth consecutive quarter of slowing growth and step down from the 6.2% recorded previously. Even allowing for the impact of the trade dispute with the US and weak factory output, the third quarter result was softer than anticipated by the market and right at the bottom end of the government's full-year growth target of between 6 and 6.5%. Recent trade data has shown both deteriorating domestic demand, with imports falling for the fifth consecutive month, while the slowdown in exports has accelerated. The preliminary breakdown shows that services activity picked up, but that this was more than offset by a slowdown in industry and construction. Capital Economics China economist Julian Everett Pritchard said. But the economic pulse appears to have strengthened marginally at the start of the fourth quarter, with firmer readings in industrial production, retail sales, and infrastructure spending in September. So industrial production jumped from 4.4% year-on-year growth in August to 5.8%. So, I mean, that's a good sign, but is that natural? Manufacturing and construction a drag. Oh, there's the problem. Westpac's Elliot Clark said the slowdown was unsurprisingly driven by manufacturing and construction. Nominal annual growth in this sector has halved from 10% a year ago to 5% currently, Mr. Clark said. While PMI, Purchasing Managers Index readings, suggest a base may be forming, growth in this part of the economy is set to remain weak for some time. I mean, just look at that. Look how drastic that is. Guys, remember, I'll change to a color that you can actually see on this chart. Look at how drastic that is. You can see down here, look at that. Remember what that is? That's good old GFC. Mr. Clark noted domestic investment continued to be a constraint on growth. Investment growth in the manufacturing sector has been weak throughout 2019 after a fleeting surge in late 2018, he said. Utilities and transport spending is also struggling to accelerate from historic weak levels. This is despite significant political and financial support from local government authorities in 2018-2019. So more stimulus. Mr. Evans Pritchard said the uptick in activity is likely to be temporary. Despite a stronger September, pressure on economic activity should intensify in the coming months, he said. So cooling global demand will continue to weigh on exports. Fiscal constraints mean that infrastructure spending will wane in the near term, and recent boom in property construction looks set to unwind. Iron ore prices have fallen sharply this week over concerns that steel demand was tumbling at a time seaborne supply was rising. Okay, let's jump back here. Let's have a look. We'll go to trading economics. Let's look at the price of iron ore. I haven't looked at it in a couple of days. How's gold doing? Gold and silver, sugar, iron ore. Here we go. So it's up to 85. How's that tumbling, Mr. Newspaper Man? Okay. Well, that's from August. Yeah, from October 14th. So yeah, that's a bit of a hit, isn't it? So we're just back to where it was, well, in August. Now we're right back down. So we've lost all of that. Remember, the Australian budget is, the government's budget is pegged to the $50. A lot of the projections is based on a $50 US price for iron ore. And every portion, $10 above it, it's a big chunk of extra money for our government. So China's stimulus efforts. The iron ore spot benchmark at 86 a tonne is now down 30% from its recent peak at the end of June. The downward trend is unlikely to be arrested by a pause in the US-China trade war after talks earlier this month came up with a verbal agreement to ease hostilities. with a further easing in credit restrictions on banks has helped boost lending in recent weeks. Mr. Evans Pritchard said more stimulus is likely. We expect monetary policy to be loosened before long in response, but it will take time for this to put a floor beneath economic growth, he said. Well, there you are. I mean, one thing with our economic dependence on iron ore, with the amount of exports that were going there, my understanding is that our exporters are still profitable at 15 a tonne. But that will affect, well, royalties, that will affect the budget, that will affect everything. And it will flow through to the rest of the Australian economy. So what do you think? Are you concerned that the China-US trade war, reducing Chinese domestic demand for resources, will affect the Australian economy? How are you preparing for it? Is this a sign that Australia has become too dependent on a small basket of natural resources exported to, frankly, a communist dictatorial regime? Maybe we have. Anyway, guys, let me know what you think. And thank you to all of those that are supporting my content. If you'd like to help me produce more videos like this, I have a Patreon, Subscribestar, and other methods you can support in the link below. Take care. Have a great weekend. Talk to you later.